And with your monthly expenses fixed, that inflation causing things to get more expensive and therefore your wage increasing as well, allows you a greater gap between what your housing expense is and what your overall cash flow can be as well. Mortgage rates are insane. They've been going up like crazy. So what do you need to know? Before we get into all the details you need to know about mortgage rates, hit the subscribe button. Do this knowing that the information we're trying to provide are so that consumers can learn what they should have been taught in school. So smash that like button. And as a quick thank you, here's going to be a really sweet picture of a beautiful family growing their legacy. The average interest rate from the beginning of this year, January 2022, has now gone up here in April about 1.5 points. It means it went from a 3.49 to a 5.0 something. That is insane. What does this mean in English? It means that if you had a $600,000 loan amount, the new payment difference is over $500. First question that comes into our mind is, why are rates increasing? Many people will tell you, well, it's because of the Fed. Not necessarily true, because the Federal Reserve does not control a 30-year fixed rate mortgage. They control the Federal Reserve rate. What then affects a 30-year fixed rate mortgage? Well, here's the basics. When the economy is doing bad, investors take money out of stocks and they put it into bonds. Bonds is the heart that breathes or that births interest rates. So when the economy is doing bad and investors take their money out and put it in stocks, those yield make rates really low. So right now when the Fed is saying that they're increasing their interest rate, again, it doesn't mean they're bringing up their rate, but they're also saying something else. They're clearing off their balance sheet. See, during COVID, the Federal Reserve started buying up so many mortgage-backed securities that it actually hedged up our economy and made investors want to keep investing into stocks instead of rates going even lower than I think they could have actually gone. But now at this point, the Federal Reserve bought so many mortgage-backed securities, they're now trying to sell them off. They're clearing off their balance sheet. And as they clear that off, rates are rising. That in combination with them trying to raise the overall interest rate as well are both the two double edges to the sword, piercing rates to a new level. This brings me to my next question. What will rates do? Well, look at the historical trends. What we've seen in history is that typically when inflation is going up and the government or the Federal Reserve tries to combat that inflation with increasing their interest rate, what typically happens after combat inflation, is recession. And when the recession hits, again, economy bad, rates go low. My personal perspective, and what I share with a lot of people who are way more intelligent than me that I study under, is that rates have a really high possibility of going down. I am structuring my entire real estate portfolio in hopes that they will. And I think they're going to go down in a pretty effective way. So much so that there's a lot of savings that could be coming for us here in the near future. So most people, when they hear that, they go, well,
what should I do? Should I just wait
until I get that lower rate and then I buy? Well, realize you don't want to just look at locking your interest rate. You want to look at locking in the other things. Like, for example, purchase price. You want to lock in that price because if you buy it now at, let's say, a house of $800,000 and then you wait a year for rates to go down, then all of a sudden that house of $800,000 can be worth $825,000 or more. And now you're waiting for the lower rates, yet what didn't get fixed was your purchase price. And guess what? When your purchase price doesn't get fixed, another part of your payment doesn't get fixed. Your tax rate, right? So if your price goes up, now the tax amount that you're going to be taxed, because your tax rate is based on the purchase price, goes up too. So when people ask me, so if rates are going to go down, should I wait to buy? The question is, do you want to save the most money or not? If you want to save the most money, typically it's going to make more savings for you to buy now, lock in the price range, get into that interest rate, and then lock in that tax rate. Because later on, when rates go down, you can keep the same price, you can keep the same taxes, and you can refinance and drop your payment even lower. See, when you own a home, what should be happening is that debt you have should be the highest amount of debt in comparison to your income that you'll ever have in your life for that house. Because when you refinance, if you refinance correctly, that payment drops. But what went up? Typically your wage. So you can buy now, higher interest rate, lock in the price, lock in the taxes, or buy later, buy higher price, have higher taxes, but lower rate. Yet, if we're just comparing that, you might still think, well, I think I might wait. Keep in mind, one of the beautiful things about mortgage is that you get to manage it and leverage it. So if you buy now, higher rate, locked in taxes, locked in price point, and then rates go down, guess what you got to do? Refinance. And when you refinance, you can lower your payment, keep the locked in price, keep the locked in taxes, and overall have a lower monthly payment than you would have if you would have waited to buy later. This is one of the beautiful things about owning real estate property. You get to have a protection against the invisible tax of inflation, right? Inflation is going to cause that income to go up. And with your monthly expenses fixed, that inflation causing things to get more expensive and therefore your wage increasing as well allows you a greater gap between what your housing expense is and what your overall cash flow can be as well. So what should you do to save even more outside of trying to buy sooner than later? Here's what I'll leave you guys with. If you want to get the most amount of savings outside of just that step, when you're making a move now, don't let people trick you into points or even a 30-year fixed rate mortgage, because those might rob you for more savings if you're planning to only borrow this money for a certain amount of time. Make sure you find somebody intelligent enough to show you what would the points cost, or what would the buy down cost? What will be my return rate on that? When do I become even? When do I make up the expenses I spent? And should I look at an ARM? Will an ARM loan give me lower interest rates? Will that give me more savings? Because if you get an ARM now with the lower interest rate that saves you, let's call it $200 a month, and you refinance in a year, that year's worth of saving for $2,400 you just were able to add into your pocket because you still refinance at that same time. So make sure you meet with somebody to analyze what options you have, which one's going to save you the most in light of where you think rates are going to be going. And if you think they're going to be going lower, don't set yourself up to lose money. Like, comment, share any thoughts you have, and I'll chat with you in the comments.